A lot of the investors that you spoke with back in 2018, one, are they getting therapy today, knowing that they told you no? But two, I'd be curious to know, like, are there examples that you could share as to like what
Yeah,
these?
I got one good one.
Hey everyone, welcome to our latest TDR Cannabis exclusive. Thanks for checking in. I am your host, Shad Dales. A lot of going on in the cannabis space. There's never a dull moment. What can we expect over the next 6 months? A lot's going to change. I know a lot of people are down about whether safe banking is going to approve or not, but we've had these conversations over the last 6 months. Don't focus necessarily on just the public equity side. There's opportunities on the private side. And what do I mean by that? Let's bring in one of the thought leaders in the cannabis space, Rob Sechrist from the Pelorus Management Group. Good to see you again.
How's it going? Good to see you too.
Good to see you. Ben Smith, lead financial writer. Good to see you.
Good to see you guys. Good to be here.
Rob, I know this is important, I think, to share. You just finished an epic trip overseas in Germany that saw how many miles did you race over the course of 2 weeks?
Well, I drove probably 800 miles on a couple of different tracks, but I was waiting to get onto the second track. These are the Nürburgring and Spa. They have to be, there has to be an event where you can get onto the tracks. And so I had a few days, 5 nights in between those two tracks. And so I just decided to take my own one-man rally across Europe. And I think I drove almost 3,000 miles in 5 days, which was epic, across Germany, through Austria, through Italy, through Switzerland, France, Luxembourg,
Wow.
Belgium, just freaking going crazy. And, you know, I was lucky to get great weather. So it was an awesome trip.
What were you driving?
I rented an M4, which is a great car, and it's reasonably practical for cars can be very expensive to rent in Europe, and SICK is probably the least expensive, and you can get the best car there. The problem is my initial trip was going to be to head to Croatia, to Dubrovnik, but apparently they wouldn't let me take the car there.
Oh, no. Why was that?
I don't know. They let you take any other level car, but I didn't realize until I was driving out and they were asking me what countries I was going to. I don't know if it's an insurance issue
Gotcha.
or what, but I was supposed to go to Slovenia and Croatia was initially the trip, but that didn't work out.
Huh.
But it was
Well,
fine.
listen, great to catch up. I bring this stuff up too because I know that you guys are very calculated in the decisions that you make business wise. I know racing is definitely part of the lifestyle that you guys have done, and it's not just for fun. That you guys are very good at this, and we got to experience that last fall in Palm Springs. But one of the, I guess, reasons I wanted to have you on here today, we've had a lot of feedback, had a lot of people reach out that are starting to pivot more to the private side. Knowing that again, we've had these conversations for 6, 7, 8 months now regarding the uncertainty in the short term regarding the space. We're seeing a lot of growth. We're seeing a lot of maturity in the industry. But what I'm trying to educate our viewers is based on the private side and basically what you do. So first question, I know we took part in a webinar a couple of weeks ago, which I thought was great, that you held. What would you say if someone asks you, is your core business?
Yeah, so the Pelorus Fund is just simply a private mortgage REIT that lends to specialty use properties. That specialty use property is cannabis use properties, and that's all we do. We only lend on that type of commercial real estate, and it's a very niche asset class. And we like to say it's most similar to cold storage, data center, or lab space because of the specialty use nature of it.
So, next question I wanted to touch on, we get into the whole banking and lending landscape in cannabis. Regulatory reform is on the horizon as well. But explain maybe the difference between an equity REIT versus a mortgage REIT.
Yeah, so equity REITs own the real estate. So they get the appreciation of the real estate. Their investors get the depreciation passed through as well. And they're generally they're effectively what we would call 100% loan to value long-term debt instrument. So typically, an equity REIT is going to write a lease rate on the property that they purchased to get that entire money back over the next 15 to 20 years. So basically, they 100% cash out the seller of that property, and then they enter in a lease agreement with the previous seller as the new tenant, and that lease rate will then return the capital, what the purchase price is over the next 15 to 20 years, whatever that term is. Mortgage REIT, on the other hand, is a debt lender or just simply a lender. So the owner of the real estate still owns their property, and we still have that protective equity, personal and corporate guarantees, and all the collateral that we have. But we can be paid off at any time if more favorable vehicles or pricing or things change from the regulatory horizon. So, our stance is that equity REITs are great models, but in this emerging sector, it may not be the best strategy to be selling your asset where you could never recapture, or you're in a escalating lease rate for the next 15 to 20 years and you can never get out of that.
No, that's a lifetime in this industry, right?
Yeah.
Ben, you wanted to touch on a few things?
Yeah, I want to touch on safe banking, some of the regulatory stuff. I know you don't get in the weeds on that too much, but and obviously your income fund mortgage REIT is different than public equity, of course. But are you seeing an increase in interest as the public markets sort of stagnate a little bit? Are more people sort of curious about the fund and getting to know something that with more consistent returns as opposed to investing in equity, which hasn't produced good returns over time?
Yeah, that's a great question. So we have kind of two sectors or types of investors in our fund. We have our retail investors, and I would say that the retail investors really, that is a non-issue for them. There are some retail investors that would prefer, for convenience, to use major custodials such as Fidelity or Schwab. And because we're cannabis related, we can't get up onto those platforms, even though we were approved on Schwab. They just won't let us board anybody. And so I think there might be a little bit broader universe of potential investors or capital to bring in there. But as the individual mindset, they're way past any issues from that particular from those issues. But conversely, on the institutional side, they are more looking for coverage, political and reputational and moral coverage, that they're not in the wrong, and that they're not pushing the limit on anything. Now, there are institutionals in our bond and some other things that we are working on, but they are not precluded from being in. It's just that they believe that there's a reputational risk and some potential risks to them, and they're just not willing to cross that bridge, a lot of them, yet. But I mean, even today, I've been had an institutional, what are they called? I'm blanking on what they're called. A person that aggregates all the due diligence for institutionals. Gosh, I'm just losing. It's Mercer is the name, and they've got clients that are interested in getting information on us. So I think that, to answer your question more broadly, I think that as we get closer and closer to safe banking or something happening to help give coverage or to deconflict the issues there, I think that more institutionals will feel comfortable getting in the space, and we've been educating them for a number of years, knowing that at some point they're going to come in larger universe are going to come in. And so we're trying to make sure that we're top of mind when that happens for them.
We see so much change in this industry. Like, think about where it was even as little as 6 months ago to where we are now. I'd like to maybe learn a little bit as to how much, or not even how much, what do you think is the biggest lesson or the most that you've actually taught a lot of these institutions over the last year, 2 years, as the industry has pivoted? And to your point, they're gaining more and more interest as we inch closer to potentially getting approval of safe banking.
Yeah, so I would say that, when we first launched the fund in 2018, I met with 50 asset managers. Not really any institutionals per se, maybe some could be qualified as that. And they all said that this is impossible. You could never put up those types of returns. And they gave us all these reasons of why that this is never going to work, or come back to us in a few years. Well, I can say today that many of those people we still have relationships with, and they could have been a lead investor and had some preferred economics if they were to have been the first ones to move. And today, so a couple of those have come back after the fact, after we put up the returns and what we've done, and offered to come in for those preferred economics, and we said no. And that's because we built the entire capital base ultimately from retail investors back in 2018, and in those first years. We never got any large lead investors. So we aggregated hundreds and hundreds and hundreds of retail investors and aggregated them over time and aggregated that. And so we actually never landed or brought in a lead investor. And by the time that ones were coming to us, we didn't have anything that we're willing to offer them.
Now, just for our audience who are maybe not familiar, can you just sort of recap what your returns have been since inception in 2018 and to now?
Yeah, so our target yield is 12 to 15% net IRR. We make monthly distributions of around 1% per month. And we've been able to achieve that, every single year we've been in full operation. One year we're at 11.9%, but just a smidge under. And we did that year that we were low. We did that with carrying 120 million in cash drag, with only 240 million of assets under management during that particular year. So you can see what kind of potential the fund has as far as generating income. And we've done many of the first in the industry. We were the first to be a dedicated lender to this particular sector and support the sector so that people didn't have to use just pure equity. We were the first to create a dedicated vehicle. We were the first to do a private mortgage REIT. We were the first to do a debt offering. And for a mortgage REIT, we were the first to get investment grade rated, and we were the first to recently get upgraded to an A-flat credit rating for our 50 million secured bond offering, which nobody's achieved, including both publics and privates in the sector.
Wow.
So in other words, in late last year, when core CPI was at about 10% in the US, investors in this fund could have beaten that with the returns, with the monthly distribution, had they invested in your fund.
Yeah, and when we've been managing, new investors coming in all throughout that process, through the volatility of the stock market and everything that's happened in the last 12 months with the rates going wider.
Yeah, a lot of the investors that you spoke with back in 2018. One, are they getting therapy today, knowing that they told you no? But two, I'd be curious to know, are there examples that you could share as to what these?
I got one good one.
All right, let me hear it.
No names though, Rob. No names.
Yeah, so one of the investors who is an institutional, and they are currently an investor, they said to me, he said, Rob, I think that we're the case study, Harvard Business School case study of exactly what not to do.
Wow.
We could have been a lead investor easily for less than what we came in for. And now we've just got regular economics, just like every other investor, and we could have done it. And we've been tracking you since day one.
But just for my own knowledge, Rob, what would differentiate a lead investor from just a regular investor? What sort of preferred advantages would the lead get?
Sure. So, if a fund has a large commitment in the beginning to help move the velocity of capital, generally a fund doesn't even launch unless they've got some commitments from various lead investors to kind of kick it off. So, if you've got $100 million fund, you might have 10, 20 million that is already preceded that when you go and roll out, you say, hey, look, we're raising the balance of this fund. We've got XYZ into the fund already, and it helps drive the capital. And so typically for that initial pre-commitment before everybody comes in, an investor might say, hey, look, I want some shared economics or better, something better because I'm giving you this massive commitment early before anybody else is here. And so that's typically some structures that are typical out there, but we never did that.
One thing that's an important topic, and I know we've discussed this before, and I think it's important to keep this conversation going, is understanding that, yes, you're on the private side, but yes, you want safe banking to basically pass. Do you want to elaborate on that?
Yeah, no, absolutely. So look, our goal here is to provide the lowest cost capital that we can. I know that some of our borrowers would, or potential borrowers would think that that's absurd how I'm saying that, but remember, the only other form of providing capital to the sector prior to us as being the first dedicated lender was pure equity. Pure equity is significantly more expensive because you have sold your company at generally the worst possible time when it's emerging, and that's a forever cost. Whereas opposed to us coming in and providing some debt, albeit that it's a higher cost than typical loan rates, it's significantly less than what equity would be, and you can refinance out when with a lower cost of capital as the markets evolve. So I think that when we initially came out into the industry, a lot of people were frustrated with the cost of the capital. But remember, the cost of the capital is driven by what was necessary to raise the money to provide it to them. It's not that we arbitrarily just go set the highest possible rate we can. We're actually trying to bridge the gap of finding a sweet spot of what works for the borrowers, but yet is still attractive enough for us to raise the capital from the investors. And remember, this sector is extremely difficult to raise capital for anybody. And so especially as the emerging fund in a new sector, it was very challenging. So we're happy that we were able to provide that solution.
Yeah.
If it doesn't work for somebody, then go sell your equity and go another direction. But when you get to the size and scale of the transactions that we're doing, you may not even be able to aggregate that much equity.
Now, is the cost of capital for some of these MSOs and private operators, is it going down over time? I know we saw a significant decrease in 2021 and so forth, and that sort of petered out as interest rates have gone up overall.
So we talk to analysts about this all the time. Everybody seems to just group the rate on the debt as all equal. There are corporate notes, and there might be what's called the face value or the note rate of that, but there might be other elements of that transaction that are not being bandied about that are potentially warrant equity kickers, origination fees, exit fees. There's all these other elements to debt that are not all equal when everybody just says what the rate is. In addition to that, you have different types of debt. Construction loans are significantly higher than a fully stabilized transaction. And so that should be categorized and mentioned when you're saying that Pelorus closed this type of loan and somebody goes, oh my gosh, that's a really high rate. Well, that might have been a construction loan as opposed to a fully stabilized, which would be lower. And then additionally, you have tier one MSOs, multi-billion-dollar market caps at the time, that are pledging all of their assets for $100 million, $200 million, $400 million. And those corporate notes are a different type than just your typical secured that's by an individual asset. And so some of those notes we saw go down to as low as I think 8% or so. But the devil's in the details on those. When those loans, we may or may not know all the elements that were part of those notes, and also what are the conditions that are the covenants of those notes, which is just as important on those corporate loans, because there might be financial covenants within that loan that if they breach those covenants, that the rate kicks up or kickers are put in automatically, and that wasn't all discussed in that. So it's
can you give an example related to that?
Yeah, I'm just, I don't have any specific examples because we haven't done any of those or seen any of those, but I'm just saying that typically corporate debt has covenants. All loans have some forms of covenants. A single asset like we do is less restrictive on, and then when you move to corporate debt across everything, you might have minimum cash flows that are required, cash reserves that are required. You might have minimum share prices that are equity balances that are required. And so if you go below those thresholds, what is the what if you go below that trigger point, what is then the additional cost of that? So you might have had
Right.
a very favorable 8%, but if like it required that your market cap to remain at all times more than $1 billion net, of assets or whatever it might be, and you go over that, there might be a warrant coverage that kicks in, and now your cost of capital that was 8% might be like 25%, depending on what the share price was at the time and how you evaluate it.
Wow.
Yeah, some of the notes issued on some of the MSOs, I think, are worth more than the market cap of some of these companies. So maybe some of those covenants have triggered. We don't know. Devil's in the details, but you don't have to worry about that with you, right? You generally less restrictive than
Yeah,
maybe some of
yeah,
the charter
and
banks.
that's an advantage of coming with us. So I do know that some of the loans that we've paid off and looked at had covenants in them. You might have been required to. This was not a corporate note of. This was just on lenders that had a slightly different lending model than us, and it might have had something like you might have needed to have 25% increase per quarter of EBITDA. And if you breach that, then you're technically in default. You might have had certain cash flow requirements. You might have needed approval from the lender if you wanted to sell the company, or to bring in a key employee, or to do a compensation change of what was already approved. So there's all kinds of different models out there.
Yeah. One important thing to mention too, we talked about earlier about how you would like to see safe banking passing. And I know we discussed this before about the differences between a special use lender like yourself, Pelorus, and that of a traditional bank lender. One of the things that really grabbed my attention is that if and when Safe does passes, the banks will actually lean to you based on a lot of expertise, direction, and the current model that you have in place. Can you elaborate on what I mean by that, and actually how that'll actually create even more opportunity for you as far as business wise when dealing with the banks, if and when, like I said, Safe does pass?
Yeah. So first of all, just to reiterate, we really support our borrowers in the industry, and we want to have the most profitable companies out there possible, whether they're our borrowers or not. We want everybody to do well, and I think that safe banking and anything to deconflict state policy from federal policy is positive for the industry. Um, Today, of the 684 banks that are currently listed on FinCEN's website, of those ones that are lending, most of those don't have the ability to go more than up to 5 million, maybe even less, maybe 2.5 million. There's fairly small balance loan lenders, banks. Many of them have less assets under management than we do. And there might be regional banks, community banks, state chartered banks. There are federally chartered banks as well. And so because of they're in the banking landscape, they don't have the ability to do the larger scale transactions, and they certainly don't have the ability to understand, secondary markets and understanding all the licensing landscape. And they've never been in the sector before, so that forces them to start analyzing the property in a only way that they know how to do, which is in the traditional landscape of just pure income and what the alternative value would be. And so that doesn't work for cannabis when you're building a property that the improvements alone may be worth more than what the building cost. And you have to understand the licensing. And if you're a bank, you may or may not be able to actually tie up the cannabis use operator license and hold that license. And you certainly probably can't take that asset back and hold that license directly. So you're precluded from being able to foreclose on that property and utilize it for the highest and best use. And so that's why the banks are having to most banks are having to look at it from an alternative valuation basis. And that's a bad position for a cannabis operator. Let's
100%.
just say, for random numbers, it's a $10 million cost basis property. Let's just say it's $5 million purchase and $5 million of improvements, so $10 million. A traditional bank might say, look, yeah, we can only look at the 5 million purchase, and we're going to have to look at what that property would be worth if it was not cannabis. And let's just say that then it comes down to 3 million, and we're only able to go up to 50% loan to value because it's in a secondary market. So now you're up to 1.5 million.
Yeah.
Whereas Pelorus, on that same loan, we would use the $10 million cost basis, and we would go up to 6 million on that. And so, yeah, the bank might be 8%, and we might be 12% on that or something like that. But the additional cost of that equity that you had to bring in, or the equity that we freed up, what's the opportunity cost of that?
Yeah. Do you have a lot of tier 1, tier 2 companies right now that you're speaking with? Because these companies need money and they need it fast.
Our company is broken into kind of two compartments. My team, we manage all of the inflows and the management of the fund.
Yeah.
So we're about 3 people direct, and then we have a third-party fund administrator and auditors and everybody else that we work with. The other 9 people of the company are all on the origination side, so they can give you a more timely answer on that. I think that we're here and have talks with people going on at all times at all different levels.
Yeah.
Whether it's tier 1, tier 2, or whatever they might currently be, and privates. But we're open to looking at all those.
Yep.
And there's all kinds of great transactions out there. We still see transactions even today that are completely free and clear of any debt. And so they're looking to expand, and they're looking to utilize that, free up that equity that they have and to expand into markets and take advantage of some of the repositioning of assets across the country. So, as some people are not able to, businesses are not able to stay competitive in the market, they might start looking to team up with other people that have more capital, potentially more different ideas on how to make the business more efficient and more profitable.
Lots to unpack and lots to learn, that's for sure. But this has been great. Ben, is there anything else you wanted to add?
No, that's it. I was just going to say that there's a new market origination in Alabama now. So it's in the medical market's moving to the deep south. So, a lot of markets are opening up and unlocking, and the world's your oyster, is it not?
Yeah, it is. And I think that something that is not talked about or even known that broadly is that we typically only talk about the state market out there that exists, which is traditionally starts off as medical and then it goes recreational. But in reality, there's a whole other landscape, and that's the federal market, and that's the DEA licensed facilities, and that market is going to be enormous as well.
How big when you say enormous?
Well, so the DEA side has to be associated with research.
Okay.
So most people have traditionally thought that is obviously a smaller market share than what the potentiality is for recreational across all 50 states. But the part that people may not know or realize is that once we've got some positive studies, which I think that some of those are already in the process of coming out from the DEA licensed research facilities that are already up and running, is that the product produced out of these federal facilities can go to federal agencies, the Department of the Veterans Affairs, Department of Homeland Security. So PTSD. So there's a huge market. In fact, I just heard today on Huberman report that like 13% of the country, if I remember correctly, was potentially has PTSD. And if you can utilize cannabis,
Rob, there's 14 million people in America right now with PTSD. Those are the estimated numbers right now. That's a huge number. So
that's an enormous market there, and we're just talking about one potential lane. So Department of Homeland Security, I was told, already has the approval to bring in cannabis, and we've lent on a DEA federal facility. And the CEO had told me the last time I was there that they're working on trying to get the approval for the Department of Veterans, so Veterans Affairs. So that'll be an enormous contract. And the other thing that's interesting about the federal side, they can cross state lines, they can import, they can export, and they can go public. They don't have any 280E issues. And so they're in a different league than everybody else at this part of the game, other than the fact that their universe of who they can sell to and buy from has to be federally licensed facilities, and you can't cross-pollinate. You cannot have a state regulatory license associated with a federal license.
What is the name of the DEA facility that we had a tour with that you guys are lending to?
Yeah, it's Royal Emerald Pharmaceuticals. Off the top of my head is, I think, what the name of it is.
How's that progressing construction-wise from the last time we were there, which, believe it or not, it's been 7 months. Where's time go?
Man, gosh. So what's interesting about the DEA license is that you've got all this government red tape. And so when we went there, that was an ex-Target facility, I think 100 and something thousand square feet. And the DEA license was requiring them to build the entire facility prior to doing any sales or doing anything to get their approval. And it's just not feasible from a capital cost basis to build that entire facility all the way to spec at DEA level, GMP certified level for the whole facility. And so they have gone back and asked them if they would approve phasing it. And so I believe that they've finally gotten that approved. And in reality, I think that I might be misspeaking here, but I think that for the phasing, they actually just say you've got to complete this section here first before we can ever issue the approval. So the red tape when you get involved with the federal government or any agency is difficult. I'm not up to speed on that transaction, but I believe that they got that all worked through and it's progressing now.
Last thing I'll leave, and probably the most important thing, I probably should have brought this up off the top. You recently changed the name from Pelorus Equity Group to now the Pelorus Capital Group. I said Pelorus Management Group off the top. My apologies. It is Pelorus Capital Group. But why the name change?
Yeah, well, you're actually right on Management Group too as well. So Pelorus Equity Group is actually a licensed real estate broker out of California, how we syndicate our California transactions. And so Pelorus Equity Group, the branding, the name of the company that we started under in 2010 is what everything started under. And then the fund, when we launched the fund actually has its own license, and the fund is able to lend across the country. And so we were basically utilizing and promoting Pelorus Equity Group, but in reality, the manager of the fund is Pelorus Management Group, and then the owner of Pelorus Management Group is Pelorus Capital Group. And so we eventually, we've been internally discussing that we've got to basically move from Pelorus Equity Group, which doesn't do any business, that we don't syndicate and do any transactions under that license. We should move under the fund. And so that's why we changed to Pelorus Capital Group, which owns Pelorus Management Group, which is the manager of the Pelorus Fund.
People that want to know more about the fund, average check size again is?
I believe that we're around 267,000 or so per is the average check size, but we accept investments as low as 50,000 to get started. And they could reach out to us at investor relations or IR at Pelorus, Pelorus, CG.com. So IR at PelorusCG.com and request information. We're happy to send it to you.
That's great. Got to have you on another Twitter space. That was a couple of weeks ago with a couple different thought leaders. But we had Jason Wild on a couple of days afterwards. Learned a lot.
I just had a call with him yesterday. There's some good, exciting things coming.
Interesting. Always good to connect with you. Keep in touch, okay?
You can't leave us hanging like that, Rob.
I know.
Well, they're publicly traded. What's out, the universe of what's out there.
Yeah.
But we're really, he's a great person and very just a normal guy, does great business practices and mindset, and the way that he works with people, both internally with his organization and externally with counterparties, is just an amazing operator.
Yeah.
So
Interesting.
his fund and his company that Terrascend is great, and we're really happy to have him in our book. And that relationship started building over years of he and I being keynote speakers at Benzinga and just getting to know each other. And, we were not the most proceeds for a loan if he was to do a loan, but the relationship that we had built, but when we originated that transaction, we were lower proceeds than some of our peers, but he had gotten to know us so well and how the principles we stood for, that's why he decided to go with us.
Yeah, I see that totally. Good stuff. Well, maybe we should have you guys on the same time. The next, we'll reach out to them. But I think these conversations, because I think the message is just, look, the industry's growing. Let's not get all obsessed about what's going to happen in the next month or two. And yes, a lot of stocks have been down quite a bit, but the most important thing, and I think you repeat this over and over, is the overall growth of the industry, as you said, is bigger than both Major League Baseball and the NFL combined. If I'm understanding that correctly, is it the Major League Baseball and NFL?
That's correct. It's significantly bigger than those two combined. It's probably bigger now than adding the NBA as well. I tell people, look, the revenue is going to flow through this industry.
Yeah.
And it's unfortunate. I think that the valuations of the stocks in the previous years were mainly not on any fundamentals out there. There really hasn't been any companies that had profitability to justify those market caps. And it was just hey, this is what we believe it is worth. And it was primarily driven by retail investors. And that's just a lot of emotion buying that. And so I do believe that we will get some regulatory reform at some point. Will it be within this year or this administration? Let's hope. But it'll come at some point. And when that does come, those valuations, when we get the 280E removed, that alone is going to add 20 to 40% to everybody's bottom line. It's massive.
Yeah, we've had a lot of people reach out as well to say, like, what's more important, federal legalization or getting rid of 280E? And I'm like, it's all about getting rid of 280E is the first step, descheduling and going from a Schedule 1 to a Schedule 3. But one can only hope. Let's just first hope that Joe Biden remembers his name tomorrow, and then we'll kind of go from there. But anyways, I don't want to make this into a political podcast, but this has been good. People have reached out. You know where to reach, obviously, Rob, if you want to learn more about investing in the fund. But as usual, Rob, appreciate you checking in.
Sounds good. Take care, guys.
Thanks, guys.
So what'd you all think of the interview? Did you like what we recorded with our guests? Then leave a comment below and let us know what you thought of it. And if there's any more questions you want us to ask, as usual, share this video with your network. Click on that bell for all notifications. And most importantly, subscribe to our channel because we would not be here without you. Thanks for watching, everyone.